As promised, we shall now have a word on taxes. This segment is presented to us by Accurate Records and Tax Services, where the Chief CPA is Mr. Adil Baloch, a well-recognized gentleman in our community. Mr. Baloch will be joined by the moderator here today, Mr. Daniel Wright, who is also well known in the arena of family law. Today, these two gentlemen will be talking to us about the differences between the traditional IRA and the Roth IRA. Let's learn, look, and listen.
Hi, my name is Dan Wright. I'm an attorney. My office for the practice of law is in Rockville, Maryland. With me today is my good friend, Mr. Adil Baloch, who is a certified public accountant who has his office in Gaithersburg. Adil, welcome to the show.
Thank you.
Today we're going to be talking about retirement accounts. Mr. Baloch, what is the difference between a traditional IRA account and a Roth IRA that we've heard so much about?
Good. It's basically the only thing common actually about these two accounts is that they're both individual retirement accounts. One being Roth, one being a traditional, obviously. Mm-hmm. They both have their differences on how the tax treatment is applied to them, what is the applicability as far as the income levels are concerned. Your question has two parts to it, but before I answer your question, let me clarify one thing that neither I myself or Dan here, neither one of us are financial planners. So everything that we're addressing here is from a purely tax benefit perspective. As far as getting into these and choosing one for yourself and what kind of contribution you should be making and how you should be setting them up and everything, the best thing would be to consult with a financial planner. But anyways, basic information does not change, it stays the same, and that's what we're going to be discussing and covering here. So your question has two parts, Dan. The first part, obviously, the difference, right. What the basic difference between the two. So for example, a traditional IRA, individual retirement account, the tax benefit is upfront. You actually get a deduction if you make that contribution within the year that you actually make the contribution in. But then when it's time for you to make the draws, when you reach the retirement age of 59 and a half or older, obviously you pay taxes at that time as an ordinary income when you start taking the draws. Roth IRA, on the other hand, when you make the contributions up front, there is no tax deduction up front, so you just make the contribution with no benefit up front at all. But when you start taking the draws, you pay taxes only on the earnings part of it because it was pre-tax money and it was post-tax money and no tax benefit was provided to you at the time of contribution. Now you can take it out tax-free and so on and so forth. Another basic difference between the two is obviously there's income thresholds. Mm-hmm. There is an income threshold in case of traditional IRA. If you go beyond a certain income level, you cannot make the contributions. Traditional IRA, however, you can just make the contributions as long as you qualify. It has its own restrictions, but as long as you qualify, there is no limit as far as the income goes.
Well, Adil, do they tax the gains along the way in a Roth IRA? Not
until you, the gains typically are reinvested back into the account, mm-hmm. So the gains actually are taxed when there's a tax transaction, meaning when you take the draw out of that. Correct.
So with a Roth, you put pre-tax dollars in, and when you take the money out, when you retire,
post-tax, you mean? Yes.
Still might be taxed again on some of the gains.
Correct.
Okay.
Yes.
What about a traditional IRA account?
Traditional IRA, everything, as I said, when you take the draw, mm-hmm. it's taxed as if it was ordinary income because they give you the benefit on taxes on your contributions up front. You put the money in, you take pretty much the whole amount off mm-hmm. from your income, so you don't pay taxes on that amount. So in Roth IRA, because they don't let you take the tax deduction on the principal up front, mm-hmm. they do not tax you at the end. They only tax you on the gains or earnings. But traditional, because they let you take the tax benefit on the contributions, now you pay ordinary taxes on the draws plus the earnings. So the whole thing gets taxed at that time.
I see. is there a maximum amount that a person can contribute to these?
Yes, for in both the cases, there are certain thresholds. There's a threshold for just a regular contribution. There's a catch-up clause in there also. If you're over a certain age, then you get an additional $1,000 or so that you can add to the amount of the allowable amount. So yes, there is a threshold on how much you can contribute.
Okay. Which has the higher threshold?
Well, as far as the threshold goes, they're both the same.
Oh, okay.
But as I said, as far as the Roth IRA goes, there is an income limitation depending on your filing status. If you go past a certain income level, it's actually phased out. So you cannot put you cannot make Roth IRA contribution once you are beyond that threshold. Obviously, if you work with a tax professional or if you do your own research and you find out what those thresholds are, obviously you will know exactly whether you qualify for it or not. Basically, what it really comes down to is that making the contributions, deciding how much to put in, how much you qualify to put in, it all comes down to your own unique situation. It's your own tax position, whether you can make the contribution or you should make the contribution or not.
I see. Now, what are the factors that one should consider when trying to decide between a traditional IRA and a Roth IRA?
Good, very good question. Basically what this question will do is sum up everything that we have talked about so far. So what that means is that, again, as I said, it all depends on your own unique tax position or your situation. Whether you want to pay taxes now, you want to take the tax benefit, or you want to pay taxes later, defer the tax benefit by taking the tax benefit right now. In which case, if you want to take the tax benefit up front, you're looking for a traditional. But if you want to defer that and you don't want to take any benefit up front, but you would rather wait when you take the draws, obviously you want to consider a Roth IRA at that time. You can also look at what income limitations you have and how you are restricted in making certain contributions based on your income level, because there are certain thresholds that come into play. Also, we haven't talked about it yet, but I'm pretty sure we're going to be talking about this as well. You also want to take into account the flexibility of what if you want to take an early draw from these accounts.
Yes.
That actually comes into play as well in making your decision.
Well, what happens if you do need to take an early draw?
Yeah. So in both the cases, there's penalties involved, of course, but there's exceptions. Both of these have their own exceptions on what the draws, what the penalties might, what the exceptions might be. But one basic difference is that Roth IRA, you can actually potentially avoid a significant amount as far as the penalties go. But traditional, if you take the draw, it's almost impossible to avoid the penalties unless the exceptions that apply. There's exemptions that possibly apply in both the cases. And before you ask me,
what are some of the exemptions?
I knew that was coming. So yeah, as a natural extension to your question, the exceptions would be for a first-time home buyer, $10,000, you can take it out, no penalties there. For higher education purposes, if you have children going to college, and you unfortunately did not save enough to cover for college, or you would like to tap into some of your savings or investments, your traditional and Roth, both the IRAs are actually an option to tap into and pay for your children's higher education or your own higher education and avoid the penalty altogether. So those are the two exceptions that will avoid.
What if a person becomes unemployed or has medical bills? So
hardships, yes, they would qualify you for that also, as long as it is justifiable and it's economically necessary to do something like that. Yes.
Well, who makes the call whether something's a hardship or not?
You make your case.
Yeah.
And the IRS will decide. But there's guidelines. You follow those guidelines, and you probably will know the answer before you actually do that.
So if you have an IRA at a particular brokerage firm or a bank, and you want to take the money out, and you don't want the penalty to apply, how do you go about to avoid the penalty?
So when you take out the IR, when you make the, when you take the early distribution from an IRA from
Right.
either a bank or a financial institution, what you do is you tell them how much you want withheld from that.
I see.
The penalties are not assessed at that point. Now, if you know that penalties are going to happen and you will be paying penalties, the smart thing
Yeah.
would be to actually have enough withheld.
Yes.
Which I would say just, I mean, be on the safe side, just have them withhold 40% of the amount because it could get that high. Have them withhold that much amount when you file your taxes, all the penalties and taxes and everything are calculated at that time, and then you know exactly how much you owe at that time, including the taxes, the penalties, and so on and so forth.
Who controls what goes on in the account?
For the most part, the account holder, the owner, controls how that account is invested, how the money in that account is invested. But there are restrictions around what kind of investments that are available to you. Mutual funds is applicable, is a good deal. Stocks, bonds, money market, those kind of things are available. You can actually invest in those. But if you're looking to invest that money from your traditional IRA into real estate, you want to invest that money in speculative market, you want to buy gold or something like that, no, you cannot do that. The only thing you can do possibly is you can actually set up a completely different kind of an IRA, which is which you can actually use to invest in real estate projects. It's called self-directed IRA. There's only certain people who actually are qualified or licensed to actually manage that IRA. They are considered your bank. You put your money in that bank per se, and then you channel all that money through that bank. You can actually invest that money into real estate projects and rent that real estate or whatever is it that you want to do. But you don't have access to that money. You only have access to putting that money into the real estate project that you're running. It goes from the bank into the project, and then the gains or whatever that is, whatever is coming back is going back to the bank, and that's how that money stays. But it's not, in any case, whether you are doing the traditional or you're doing the self-directed IRA, in any case, that money, if it comes back to you, it's subject to the exact same rules and regulations of early draws and withdrawals and penalties and taxes.
At what age are you allowed to take the money out without penalty?
59 and a half is the minimum. There's an upper threshold also. 59 and a half, you cannot take anything before 59 and a half, but you absolutely positively have to take it at the age of 70 and a half. You have to start taking it.
What if you forget to take the money out at 59 and a half?
So what you have is called required minimum distributions. RMD is what we call it. Based on the formula, you are required to take out certain distributions every year. If you fail to do that, now your RMD amount, your required minimum distribution, is subject to the taxes and penalties that you would have been assessed otherwise. So you have to take out the certain amount based on that formula. And again, any professional who knows this business, who understands how the formula works, will be able to help you in finding out what is your RMD requirement in a certain year.
Will a person get a notice from the IRS or from their bank about the
Not doing the RMD?
Yes.
Unfortunately, the answer to your question is yes, but unfortunately, it's usually after the fact. They do give you a notice in the beginning telling you that, this is the year that you should be planning to take the RMD, but if you do not do it, they do not let you, ask you to take it out proactively, that, look, today's the deadline, you should take it out. No, they will get back to you a month or two later and say, by the way, 2 months ago you were supposed to take out the RMD and you did not.
I see.
So it is your responsibility to keep track of that and stay on top of that.
Okay. Thank you, Adil. I'm sure this information will be very helpful for our viewers. I appreciate your expertise, and thank you for coming in today.
Thank you.
Thank you.
you.